Morning, guys. It's Thursday, July 24th, 5:23 a.m. Central Time. Grain markets are higher this morning. December corn futures up 3 1/4 at 420 3/4. November soybeans up 5 cents at 1027 3/4. December Chicago wheat up 4 cents at 565 1/4. December Kansas City wheat up 5 at 551. December spring wheat up 2 3/4 at 612 1/4. We've seen an uptick in U.S. farm bankruptcies. Why don't we start there?
We sure have. Bankruptcies have climbed to their highest level since 2020. The crisis comes amid elevated interest rates, the lingering impact of President Trump's trade war, and weakened export demand, particularly from China. Farm debt is projected to hit a record $561.8 billion this year. The situation has caused lenders to tighten collateral requirements and raise borrowing costs. While the USDA expects net farm income to rise this year, the increase is largely driven by government assistance.
So Bloomberg, of course, led off with that this is because of the trade wars. I don't agree with that, but we're going to get to that in a second. So the data in this small sample size that Bloomberg has in their charts would indicate that there's going to be less than 200 farm bankruptcies this year. It's not a huge amount. 2020 was slightly higher. I was able to pull some data going back to 1990, and I'll address the lack of data before 1990. The big farm crisis in the United States, of course, was in the 80s. And prior to 1986, there was no farm-specific bankruptcy data. They introduced Chapter 12 in 1986. I'm sure there's some banker out there that has some sort of statistics or charts on farm bankruptcies prior to that period. If you do, let me know. But if you look at this, farm bankruptcies in the United States have actually trended lower for 35 years. They're very low. We saw a slight uptick, during those kind of bear market years from 2014 through 2020. And now we've gradually trended lower, and now we're back on the rise again. There was a lot of reasons for that. So why did you see a 35-year downtrend in farm bankruptcies? Lower interest rates versus today was a big part of it. There were low interest rates for a long time. Farm consolidation, efficiency gains. There's just not as many small farms out there. Efficiency has improved quite a bit. Government support is a huge part of it. Everything from direct payments to crop insurance subsidies. You got things like MFP and COVID relief programs. I mean, just tens of billions of dollars on what seems like an annual basis now. Risk management tools have improved. Crop insurance, some of the forward contracting tools that are available to the farmer. Oh, sorry, skip slides there. Export demand growth has been good, although that's maybe in question now with some of the trade war stuff and the expansion of Brazil, and some of the bankruptcy law limitations have helped to help farmers to avoid bankruptcy. So why are we seeing the spike now? I have kind of a list of what I believe is going on, and it's not the same thing that Bloomberg said as it relates to the trade wars. Probably the biggest thing right now is just overproduction in the U.S., the expansion of Brazil. China's got some economic problems and some demand problems, perhaps. The second thing I wrote down was inflation. And inflation is hugely problematic on the farm because inflation has impacted hugely the things that you buy. Fertilizer, seed, cash rents, implements, all of those things are hugely inflated versus, say, pre-COVID levels, where the actual output, the things that you sell, corn, soybeans, wheat, have not really been affected by inflation. You look at the prices today, 420 D's corn on the board, 1027 no beans on the board. Those are prices similar to what you would have seen pre-COVID, where there's not really anything that you buy on the farm that's at a pre-COVID type price level. Higher interest rates is a problem. You've got operating lines on the farm now that are 7-8%, and that's been problematic. The interest expense is huge. To address the trade war item, I believe right now we're in the third year of what I would call like an ag or farm economy recession. 2023 was when the downturn started. It went through 2024, and now we're halfway through 2025. So blaming trade wars, I think, is slightly irresponsible. Donald Trump was not president in 23. He was not president in 24. There were no trade wars during those timeframes, yet the markets trended lower, and the ag economy recession started during those timeframes. Now, do the tensions with China help? No, they don't help. Not yet. Maybe eventually it turns into a positive, but the trade war thing is kind of low on my list. I know people are going to disagree with me on that, and they're going to call me a Trump defender or whatever. But that's just not the way that I see it. It's really not. In any case, we hope that these numbers don't get any worse, because Bloomberg indicating that we're seeing a modest spike here. My guess, as I've mentioned before, I think if these prices don't improve, the government comes to the rescue again later this year, but we'll see what happens.
China is taking measures to scale back hog production in an effort to stabilize pork prices. A surplus of hogs has created an oversupply of pork, leading to a sharp decline in prices. To support the market, authorities plan to reduce the number of breeding sows, lower slaughter weights, and restrict the expansion of new production capacity. The government also plans to continue efforts to reduce the use of soybean meal in animal feed. Alternative protein sources such as food waste, insect protein, and animal based proteins are being promoted in place of soybean meal. As a major importer of soybeans, China is seeking to enhance food security and reduce its vulnerability to global market volatility and geopolitical risks.
I read that this headline yesterday had some bearish market implications, but this is not fresh news. Bloomberg had a similar article out during the second week of June. In any case, this is perhaps a problematic headline as it relates to demand for feed grains. This is a ballpark, very much a ballpark estimate of China hog feed rations. About 58% of what they feed is corn, about 18% is soybean meal. You've got 8% that's maybe wheat, barley, sorghum, depending on the situation, some bran and DDGs mixed in there. Don't take these numbers as gospel because they are highly variable, but there's a lot of feed demand in question. And if you look at what China has imported with regard to feed grains, corn and wheat specifically, this year, that the numbers are way down. USDA is projecting that they're going to spike up a little bit during the new crop marketing year, but that's just a guess. So there are some demand problems currently, and if China does really succeed in scaling back hog production, it could become a bigger problem.
Extreme heat continues to grip much of the Corn Belt as a persistent heat dome adds stress to crops across the region. Coupled with high humidity, heat indices are expected to rise into the triple digits throughout much of the area today. Overnight lows are expected to remain in the mid to upper 70s, potentially setting records for warm minimum temperatures and adding to crop stress. Meaningful relief from the heat is not anticipated until the middle of next week. Despite the extreme heat, the market seemed disinterested as a near ideal growing season thus far has tempered concerns about potential crop damage.
Near ideal, depending on who you talk to, of course. But my take on the whole situation is that there's a large contingent of the trade working with a very big corn yield number right now, based on the crop ratings and based on precipitation. The temperatures have not been ideal. I'm going to talk about that in today's premium video. We're going to run some current temperature stuff and run some analog years and kind of see what that shows us. Heat index today is going to be like over 100 degrees throughout a lot of the U.S. Corn Belt. Looking at the heat, as Mackenzie mentioned, we're going to be hot for another not quite a week, up until maybe Wednesday next week. That's when you're going to see some cooler temperatures prevail. Our friends at Crop Profit estimate, based on GFS ensemble data, that the Corn Belt will be 5.7 degrees above normal over the next 7 days. And we've already kind of been above normal, trending above normal with regard to temperatures for the last month or so. The relief from the heat comes in during the 8 to 14 day period when you're going to be more normal with regard to temperatures. There is no problem with precipitation here the way that it looks. We're going to be above normal over the next 7 days. There's some rain on the radar over Iowa this morning, and 8 to 14 day looks pretty normal in terms of precipitation also. So again, the way that the trade views this is through a bearish lens, a big crop lens. I've heard the talk of the 185 to 187 corn yield number. I've heard a little bit of chatter of numbers north of 190. Of course, this is all up for debate.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video?
Yesterday, Jim Urio and I did a beginner inflation hedge guide. Jim is a professional trader and investor, and we talked about how a beginner would go about hedging long-term inflation. I'll show you one of the slides that we led off with. The U.S. dollar has lost 22.4% of its buying power since 2019. $1 in 2019 would have the same buying power as $1.29 today, and that's based on CPI data. I believe the inflation's actually been worse than that. But in any case, how do you protect yourself from this sort of thing? Because when we fast forward 5 years, 10 years, we're going to look at it at a number similar to this. We're going to say, since 2025, over the last 5 or 10 years, the dollar's lost 20% of its buying power, 30% or 40%, whatever the number is. You got to insulate yourself from that. And we talked about a number of strategies and specific strategies that you can do as an investor or as a farmer, and how you would go about it. There were no recommendations officially. We just kind of told you what we're doing. If you guys want to see the premium stuff, go to standardgrain.com. You could sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation. Nobody tried to sell you anything else. We just want to send you our info. We just produce a ton of content, and we send it out to our premium subscribers every single business day. What we do here on YouTube and what we do on the podcast it's a news show. We cover the topics of the day. What we do in the premium stuff is more geared toward the decision maker on the farm. If you're the person making the marketing decisions, the financial decisions, we cover all of that stuff. And our subscription has proven useful to farms across the United States and around the world. If you guys want to see this stuff, sign up this morning. I will forward you a copy of this morning's email.
North Dakota's annual wheat tour is underway. On Tuesday, Crop Scouts estimated the average yield of the state's hard red spring wheat crop in southern North Dakota at 50 bushels per acre. While that figure is below last year's tour estimate of 52.5, it remains above the 5-year average of 45.1. Scouts noted some concerns about potential disease pressure following ample rainfall, as well as isolated instances of wind damage. Then on Wednesday, Scouts surveyed fields in northwest and north central North Dakota. They projected average yields of 47.1 bushels per acre, down from 53.7 last year, but still higher than the 5-year average of 42.5 for the region.
The crop overall, I think, is decent. This makes sense to me because they said the crops in the south are good, and when you get further north, they're not as good. And that kind of lines up with what we've seen with regard to precipitation over the last 60 days. Precipitation in the southern part of the state has been normal to above normal. When you get into that northern part of the state, it's been below normal. And it's perhaps a little bit more complicated than that, but that's the way that I would read this. The spring wheat market has not acted well.
U.S. ethanol production declined last week. Weekly output of 1.08 million barrels per day was down 1% on the week and down 1.6% versus the same week last year. Ethanol stocks saw a substantial increase, climbing to 24.4 million barrels. The print was up 3.4% compared to the previous week and up 3% compared to the same week last year. Consistent with this year's overall trend, stocks remain well above seasonal levels. According to Reuters data, U.S. ethanol production margins strengthened over the last week.
Yeah, ethanol production is strong. USDA estimates that the ethanol industry will account for 36% of all corn demand this year. So ethanol is a huge deal, but has been pretty steady Eddie and has been very good this year. What did cattle do yesterday?
Cattle futures had another impressive day. Live cattle were $1.62 to $2.37 higher. Feeders saw gains ranging from $3.25 all the way up to $4.62. Box beef prices were lower. Choice was down $4.98 at $3.67.52, and select was down $2.55 at $3.45.39.
Stock market's mixed this morning. I believe the S&P posted another all-time high yesterday. Treasuries are just a little bit lower. U.S. dollar is up a little bit. Crude oil is up 75 cents, and the September WTI at $66 even. Have a great day, guys. We'll be back on Friday.